Well, guys, the results are in and Tesla is not faring well in the aftermarket. But is it all as bad as some people might make out? In today's video, we deep dive into that along with discussing the negative gamma situation we find ourselves in the options market. Also, Google, they beat, but the market still doesn't like them. Is this all part of the pullback? Well, as it turned out, the markets did exactly what we kind of suspected over the last 24 hours, making it to the most traded zone and selling off from that point. But can they continue to sell off from these levels? Well, the Nasdaq did something very, very similar. The VIX, as we expect, should hit a 20 at some point during the second half of this year. And of course, everybody is going to be asking what levels are we going to next? Well, in today's video, we break it all down together, but really it's also about these dark pool transactions, and a massive one appeared on the Russell in just the last 24 hours. Let's cover stocks, commodities, and cryptos together right now. It's going to be a good one, guys. Let's get into it. Well, welcome back everyone to The Daily Show. My name's Tom, and in today's video, we need to talk about these big tech earnings because, of course, we saw Google, one of our favorite stocks, results, great, still down aftermarket, and Tesla report, and they were down a lot more, leading into a negative gamma situation. If it's your first time here on the channel and you want to understand more about markets, remember to subscribe and smash that bell icon, especially if you want to find out how Wall Street makes some of the biggest moves, dark pool, options, and many other things we discuss here daily. Let's begin by tech, or big tech versus the rest. A chart we posted over on X shows the expectations for this Q2 are that big tech will do 18% earnings growth and the rest of the market will be doing 2% earnings growth. Now remember, the best thing about this market so far has been financials. They are kicking ass, and expectations here of home builders and financials doing well in the future is really doing well. Now it is probably because of deregulation bets, but also remember, increasing of debt is becoming the discussion point here. So has big tech been living up to the expectations? Well, we know Google kind of did, but what about Tesla? Well, here's a great chart here from AJ over on X, and it shows you a breakdown of the Tesla earnings, and effectively operating expenses are what a lot of people are worried about, along with, of course, EPS not being as high as the expectations were set. Now, it turns out that Tesla did really well with their credits on quarter, and it actually increased 100% quarter on quarter. And you'll notice here in terms of overall automotive revenue, this is still okay. It did increase over the previous one. But the now question is, what about these expenses? Well, one of them that was caught here is a once-off, most likely, of $622 million, and it's a restructuring charge. So we'll see whether that actually is true when we get some more information from Tesla. But this is an interesting one. And of course, when you're talking about research and development and increasing operating expenses to improve AI, I don't think that's necessarily a negative thing here in markets. But Tesla's earnings, certainly a little bit shaky. Some of the problems that pretty much everyone expected came through. And as we always say, price action is going to be key. So if the market can regain back above 230 and hold the range, there could be a great buy opportunity. And if the market actually holds underneath 230, it's going to turn really negative gamma through the session and could move all the way down to 200 and 210. We'll look at that in the charts a little bit later on. What about Google's earnings? Well, I posted this over on X, and you can see here that in general, it's pretty good. 14% year-on-year revenue increasing, operating income improving. They made tons of money, of course, with their cash on hand, which is to be expected, and net income is up big time. So it looks like the whole shorts and competing with TikTok is working out. Google searches was doing well. YouTube ads is doing okay. And across the board, I think it's not too bad at all. Notable points here were that cloud exceeded 10 billion quarterly for the first time. So I think that's a big one. And in general, they're moving towards more AI, blah, 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 all the normal stuff we usually see. So from decent earnings results, we now move into, of course, our expectations of what Microsoft, Apple, and the others are going to do. But really, the most important levels are coming up for the S&P 500. And if we lose some of those zones, as you'll find out later on, we could be looking at that bigger, deeper pullback just coming in the next couple of months. Remember, back end of July into August into September are generally some of the most volatile periods during election years. Let's have a look at this chart, though. I think this is an interesting one posted over on Kobayashi letter, and you'll notice it has to do with used cars. Now, they are falling through the floor. And if you are a person that is looking at a new car versus a used car, you might want to be starting to consider used car market again, because they are absolutely getting crushed. And I would expect them to continue to get crushed as probably more people started to buy more than one car. I think we had the average American household holding almost 3 cars or something at some point there during the 2020 boom. And this means that there's probably great opportunities for you guys, but it also means there's softening. We're seeing that in collectibles markets, watch markets, and used car markets. So this is showing you a softening across the board, which means that people are being hit by the high interest rates, or at least using their money more into investments. Here's a great chart though that I think is good. We've looked at rail freight a few times, and it looks like we are seeing rail freight continuing to increase. And this often pushes in front of the PMI. And we know that if the PMI is starting to do well, then that can also lead into an overall recovery in the market. Now, this is a good sign if you're a bull in markets, and certainly something you should be looking at. And it brings us to our point of where we're at. We talk about this a lot. Are we in late cycle investing? I've said many, many times on this channel, especially over the last 6 months, that I believe we're entering into the final phase of this market bull run. And you'll notice it's very similar to some of the other bull runs. The secular bull market of the 1980s into the 2000s, where we got a concentrated end, and of course the 1968 period, where we also had a concentrated markets. Now, in both cases, what did they lead into? Lost decades. So we've got to be very careful here. Are we seeing a acceleration of this pace? Because generally the period of time between these periods was actually a lot longer than what we've been running so far. Well, I do think we could be in a lost decade, and we'll talk more about that in an upcoming video. But for now, things are very good. Large cap financials, mid cap financials, and small cap financials here from All Star Charts, they're all at new highs. And this is exactly what we've been talking about on the channel for a while. If you're seeing these financials go long, that is not a bad thing for you as an investor. If you're looking at 3, 6, 9, 12, 18-month even outs, this is the type of thing that you want to see. Strong financials equals a strong debt market, which eventually ends poorly, but for now it's good. From large cap growth all the way back to small caps, that's the last 24 hours. Russell 2000 doing well, but hitting a big key level. And bringing us to an interesting point, the S&P 500 versus an equal weighted index is now at one of the worst returns it's been at for some time. And this basically shows us that we could have more upside in the Russell 2000. In fact, I think it was FactSet, so basically Tom Lee coming out, and he's calling for a 300 IWM by the end of the year. And there are some stats here that are pointing towards that being a really real possibility. Let's have a look here at small caps as a ratio. I love my long-short ratio. Jurian Kumar here putting out a nice chart. And basically it shows you that we are trading really low for quite some time underneath average ratios. You really want to see something like a 0.5 ratio to get back to here between the Russell 2000 and the S&P 500. And unless we're at that point, you're not really at fair value yet. So are we underneath fair value still? Absolutely we are. And we should be starting to see Russell 2000 do better over the next coming months. Some other breakout charts here. Here's one from Mike Zaccardi, Bank of America, of course. And they believe that we've seen a significant change, of course, in the Russell. And they're kind of looking at a huge breakout here moving forward. We already do believe this. Of course, we've hit what we would call first take profit zone at this point here. And as we'll see later on, I actually tend to agree with them, although I've got a secondary lower take profit. But after that point, yes, the standard range bound market here, which is point A, if you actually extrapolate that out, it would equal a 2620. And yeah, it could be very, very possible here, even by Christmas. If you have a look at charts such as this one here as well, where we look at the Russell 2000 coming off a 12-month low, and then we start to see the recovery in it, usually the back third, which is where we are right now, is where you get most expansion. So the Russell 2000 is really starting to heat up, and the overall breadth looks good. And of course, leading into things such as rate cuts, we might have to expect the Russell 2000 to do better. All over the S&P 500, the S&P 1500, we're seeing new highs outpacing new lows. It's really just big tech that's bringing down this market. And that is also exemplified by a chart like this, which shows you real estate, industrials, financials, and of course, utilities all going ballistic over the last couple of sessions. And this is a huge change in market. And again, something that you want to be looking at in markets across the board. If that's happening, if breadth's improving, that's a great sign. So we mostly expect a rate cut in September. Now, if you actually track all of the previous rate cuts by the Federal Reserve and you look at how the market's reacted, in general, it's pretty normal for the market to do what we call a pullback in time, which is sideways, or even a little bit of a dip before the rate cut. So if we're thinking, okay, rate cuts coming in September, what to do? Well, generally the market will actually have a bit of volatility into that event, which coincides very well with an election year volatility. And then after that, we expect the markets to actually go ballistic and go very nicely if there is no recession. Now, remember, one of our biggest reads of recession is the inverted yield curve. And if we don't see that uninvert, then we really shouldn't be too terrified by the market. But in most cases, people expect these scenarios, which are all bullish scenarios. So really whatever we see here in a pullback could still be leading into quite nice gains. And that's because I don't think we've seen what we would call a crescendo of a bubble yet. Now remember, this is all led by AI. So if AI hasn't shown extreme bubble tendencies, such as absolutely detaching from all sense of reality, we're really usually not at the top. What about CTAs? Well, we've seen CTAs dumping recently, particularly in large tech, which we'll bring up later on. And we've also seen some amazing thrusts around the market. I won't go too much into these because we've covered them in all our previous videos over the last 4 or 5 days. But we've seen a Whaley breadth thrust. We know the returns on that are absolutely stellar, quite a lot of data points. We've seen a 70 thrust. We also know that the returns on that are very stellar. And we know that in late cycle investing, these are the types of things you want to see to get the markets keep going up. In terms of earnings, there's still some big ones here. We've got Chipotle, which will be interesting after its stock split the other day. Can it live up to its high expectations? And then we have, another large amount of stocks. A lot of people looking at Roku as well. The chart on this looks pretty good. And if it does break out to the upside, even though I've long hated this stock, and for rightfully so, it went down a lot. If it breaks out to the upside, it could be an interesting play as well. So some big ones still coming through for the end of the week. And of course, now that we're past Tesla, which has pretty much lived up to its massive expectations of big moves, Google was a lot less, only about 2% down after hours. Then we move into some of the other ones. 3M as well, that's expected to be a ±7, which is a lot for that stock. Let's now move over to why we think we could be seeing volatility soon. We know the VIX structure, that's the volatility market structure, tends to accelerate at this point in time. And you'll notice here that August into September acceleration this year could be the same as 2020. So it's all happening faster than it usually does. And that's because of instability in just the candidates for this election coming through. What about the dark pool activity? Well, in the previous video, we talked about how we saw a massive VIX trade. And that massive VIX trade kind of was consistent with maybe seeing a bit of a bump up in vol. That's exactly what we saw. Up in the morning, a little bit, then it sold off those most traded zones. And this suggests there could be a little bit more selling to come, which we'll need to be watching on the price action. We also have another large trade coming through, which is a Russell 2000 short position. And there's now 2 short positions. Now, it's hard to tell here that this is actually not profit taking, because it could be, well, probably not profit taking, it's probably an entry zone. But basically, the Russell 2000, if it goes down, of course, this position would go up, and we're looking for it to retake this particular level. So RWM, something you might want to track and have a look at from the price action on your charts. Just to reiterate, if we're looking at the 1960s narrative and the 2000s narrative, there's usually a bit more to come. And that expectation leads us into a 2025 still in bull run, with pullbacks generally being met by bull demand. At least it's statistically the most likely scenario at this point now, with the evidence that we currently have. Last 24 hours, regional banks did well. Metal started to come back a little bit. Home builders doing well. And it was energy down, with, of course, US oil getting crushed into that really interesting zone we'll look at in a moment. And we also saw a few of the bigger tech stocks starting to fall off. Last 5 days now, semiconductors down about 7%, which is expected. We could see a little bit more fall off on those, which we'll look at in a moment. And the best thing about this market is that regional banks and home builders and REITs continue to do the best, which is, again, a good broad base for a continued gain in the future. Maybe not for now, but in the future, this is a pretty good sign. Let's see who won in terms of the bulls and the bears. Well, we notice here on the S&P 500, the anchored VWAP ended up getting hit. But more importantly than this, the most traded zone got hit. Now you'll notice it looks a little bit like a shooting star style candle or rejection style candle. So if we keep getting follow through on this, then it could lead us into moving underneath the most important zone, which is 54.40. Let's have a look at the futures market because we almost nailed this together, guys. So well done. You picked a perfect point. And of course, this is exactly what we wanted to see. Markets came up to the supply area. They reacted off this zone. They sold off, and they actually gave us a change of trend on the small time frames between rallies now, because of course this is a gap due to futures trade because of course, earnings season, that rallies could be met by sell demand. Now, it's a very pivotal point for buyers and sellers. Did we hit the really stacked bull zone of between 54.40 and 54.80? No, we kind of cut that short the other day, and it made us think there's more selling to come. Now, I would still be thinking, even though it's hard to be a bear and it's hard to go against this market, short term, I could make a case that small rallies will be met by sell demand and that we should at least make our way down to this level. Now, if we made our way down to this level and then went ballistic back up, I'd say that's the sell off, this thing's going long. But at this point, you can kind of see how important this level is. This is not only a 61.8 fib of the pullback, so in terms of getting back into this zone, but it's the most traded zone. It's a lot of options expectations. And more importantly, there are calls all over this area. So if this area is broken, we move from a negative gamma situation back into a positive gamma situation. We've seen how strong that's been in 2024 so far. So speaking of negative and positive gamma, the options market helped us a lot last 24 hours to figure out that exact zone. 55.85, that was smack on exactly where we expected the markets to go to. And you'll see here a huge option shift. While we had all these puts floating up here, we've now moved down to the 55.10 again for the next options expiration. This market's really being run a lot by these zero DTEs. So we're in the middle of nowhere land. We're in between 55.10 and kind of like 5,600 in terms of where the markets could trade. We do expect the TA to take over. So if we get that rally, there could be a little bit of a sell. Again, gap fill rally there on the futures into a sell. And I would like to see the market come back down to 55.10 and maybe even go underneath that to push that negative gamma situation through and for us to really test that really decent bull level that sits around 54.40 to 54.80. That is a very good bull zone. You'll notice if you then go out to the 25th, it becomes more clear that 5610 is the break zone for the market. If it gets above there, positive gamma, huge amounts of options flipping, that's going to be a big zone. But notice where the puts go to. I find this very interesting. All of a sudden, we give up the 55.10 as the most traded put zone, and we move to 54.60. Now, that's fantastic. And it does point towards that being the basing of at least the day traders for this week and the expectations here. So some really nice and interesting options flows. We know that the CTAs, as Goldman Sachs has kind of suggested, they believe in most scenarios, CTAs had to drop their positions. While they've been dropping it versus the S&P, they've obviously been dropping it versus the NASDAQ more. So the NASDAQ's been weaker across the board, and that's something to consider. We also had a big drop in gold CTAs after getting quite extended the other day, but this is 1 day delayed. So I'd be interested to know if we get a buyout because there are some okay signs on the gold market on the shorter term timeframes. Copper continues to absolutely get destroyed. We'll talk about that soon. Brent still falling off, obviously getting towards a very key zone for it. And when we move over to NVDA, we remain kind of trapped between that 120 zone and that 130 zone. So NVIDIA, if it moves underneath 120, of course, we'd love to see a 110 on it. I think that would be quite a strong level, weekly 20 moving average, etc. But yeah, not much on the options market for that. What about Tesla? Well, 265, unfortunately, those calls, they are lost, I think, after the last 24 hours. We'll see how this thing bounces. You can see how important 230 hold up is for this week. And if we move underneath there, you'll also see the convexity is moving negative gamma. So 230 plus, like going underneath that zone, it's going to need some hedging. And it could be instantly into that kind of 200 to 210 bracket, which is also a 61.8 fib, which we'll look at in a moment. So really Tesla weakening off here after hours earnings, but it needs to hold above 230. And I think the next 24 hours is going to give us a trade actually on Tesla. Let's move over to VIX. Now, we expect the VIX to hit 20 twice this year. Why? Well, you usually have to expect a VIX 20 for a pullback. Now, we talked about that over the last 24 hours. We kind of expect a VIX 20. Is this the time that's going to get it? I kind of hope so because it makes quite a lot of sense to the convexity and stuff, but we'll find out. Of course, do we need to be worried about the underlying? No, not really. High yield junk, very, very good. Regional banks, amazing right now. Home builders, fantastic, new highs. Obviously, that's all long-term bad because it means debt is being written out of control, but it's all happening right now, and that's what we need to be watching because the market cares about that. It doesn't care about, could go toxic. It cares about, well, that's growth. Debt is growth, fantastic. Let's keep moving forward. US 2-year moving back down to the 4.4%. Expectations, of course, of a rate cut in September continue to be around that 90+% according to the market. When we move over to copper, there is no bid, but we are heavily oversold at this rate. So I'm looking for structure buildup, and we will report if we get that. But right now, around the right levels, I guess. But yeah, no structure buildup means no buy on copper at this point. Dollar index coming up like we thought to around that 104.40 zone. This will be an interesting interaction for the US dollar, but no real interest just yet. You'll see it's kind of respecting this level. And one thing I noticed is that it's coiled before that. So if it does breach out and then go bad, I think there'll probably be a trade to the short end. But at this point, it's kind of just slowly melting up and we're looking for a reaction. Silver, gold, are they starting to improve? Yeah, kind of they are. You can see here that silver put in a tweezer and looks like it's trying to make a break for it to the upside after coming back down to this very important support or demand zone. And gold is, of course, stronger than silver at the moment and actually breaking out to the upside. So day traders will like the fact that it's back above 24.11.12. And this kind of suggests that at least buyers that are here would be protecting hopefully that stop loss or that like low level. So maybe gold is starting to make a move. And that's kind of consistent with the dollar also hitting a very important res zone or around that level. What about US oil? Nothing yet. Where exactly we find a nice buy zone could be coming through here, looking for structure. Close above 79.20 could be very bullish on that particular position. And of course, with oil weakening further, our little energy stock trade not doing as best as it could, back to where we kind of began it. So we'd like to see energy, of course, trip towards the upside at around this point. We need oil to structure. That's often what you look for. You look for oil to structure, then you might go and look at the energy stocks. But they had a breach out over the last week, and they're kind of coming down like a freight train at the moment. We need a bid buy candle. So we're looking for a nice green daily. Tesla moves underneath 230 in after hours. That's the 20 moving average. If it holds and sticks that, could be coming all the way back down to 207 to even 200, filling in some of these gaps that it left when it went ballistic the other day. So next 24 hours, incredibly important for Tesla. Bulls want to hold to 233 and bears want this thing to close below 230 so that they can see that negative gamma start to play out and hopefully push down to these cheaper levels. So watch and see. Again, that's why we have patience to react. Predicting Tesla's bad earnings, maybe you could have said, yeah, Tom, I know it was going to be a bad earnings, but remember, even with that last earnings was technically a bad earnings, yet the stock went ballistic up. So you've got to be just a bit careful there about making those predictions. What about Google? One of my favorite stocks did fall 2% after hours. I would like it to fall further, frankly. I mean, I think it needs to come down to about 172 to even get slightly interesting, which would also give us about a weekly 20 moving average and some anchored VWAP sitting around that point. So really, unless it's at 172, 173, it's not that interesting. Tencent, not great. Got to say the Chinese stocks continue to struggle here after the threat of tariffs has come through. Still watching. We had a decent little kind of turn, no movement above, no rally, no really strong bids here. We'll keep watching the Chinese stocks and keep looking for some opportunities there. What about the NASDAQ? Well, the NASDAQ went exactly off that bear bust area. Basically, between 19.8 and 19.9, we expected significant weakness to come through because of what we saw last week, and it failed to make that higher high. And of course, at this point, the bears are in control of this market. Now, with the NASDAQ, this could be a big key warning for the S&P as well, because if we manage to close below 19,000 kind of 450 or 470 zone, that suggests way more weakness is to come and that the markets could be falling that significant percentage that a lot of people are looking for. So we might be able to get a 10% pullback on the NASDAQ, which would be consistent with a normalized pullback in an election year and in many of these years that we get. So could we get 10%? Last 24 hours points towards maybe a seller could come through here. US 2K, big dark pool transaction right on this level, equivalent, of course, with RWM. So really we're looking to see whether there's a bigger reaction here. So the smaller caps, of course, very strong across the board, but maybe they're going to have a little bit of sell pressure put onto them. And I don't think this is anything worrisome in the markets. You expect after getting huge bull readings like we did last week, for about 2 weeks to even a month of random kind of market action. And then after that, we resume trends. Bitcoin, a little bit of a pullback into the Ethereum ETF earnings or ETF announcement and of course release. Nothing to really be worried about. I think this is just a standard pullback after that huge shoot up. We continue to be quite bullish here on Bitcoin. Very nice move as of a week and a bit ago. And that's led on to some amazing gains. And I'd like to see a pullback because that could begin a nice entry that gives us into swing. But the earnings for this week is really the big story. But of course, there is still some news that we need to talk about. We've got Flash PMI coming out on Wednesday at around 9:45 New York time. And then, of course, we have core PCE coming out at 8:30 a.m. on Friday, which is one of the key metrics by the Fed. In summary, guys, long-term, medium-term traders and investors, I don't think you really need to worry too much about what's going on here. But for, of course, the shorter-term trade investors, you're looking for that high volatility levels to be hit. So ideally, we hit somewhere around 54.40 to 54.80 on the S&P 500, and I think there could be some very interesting results around there. If you're interested in finding out more, please sign up for some of our stuff. Check out our course if you want to find out more about replication of trades and how you can find single stock and, of course, sectors and really look through those along with CFD and futures trading. And, of course, follow us over on X as well. Thanks so much, guys. We'll see you in the next one. Bye.